Tax losses and their treatment for corporate tax purposes. In the context of corporate taxation, a tax loss occurs when a business's deductible expenditures exceed its income that is subject to corporate tax. This situation is not uncommon and can occur for various reasons throughout a business's life cycle. The ability to carry forward or carry back tax losses is a crucial aspect of the corporate tax system, as it helps businesses to smooth out fluctuations in profitability and ensures fairness in the overall tax burden. In this regard, businesses that incur tax losses are allowed to use these losses to reduce their taxable income in future tax periods, subject to specific conditions. What is a tax loss? A tax loss arises when a business's total deductible expenses exceed its taxable income. Deductible expenses include operating costs such as salaries, rent, materials, interest, and other necessary expenses incurred to run the business. The concept of a tax loss allows businesses to offset this loss against future taxable profits, reducing their overall tax liability. Reasons for tax losses. It is common for businesses, particularly new or growing ones, to incur tax losses during certain periods. For example, startups and new businesses. Many new businesses invest heavily in growth during their early stages, often resulting in higher expenses than income in the short term. These businesses may incur losses as they spend on marketing, research and development, hiring, and setting up operations. Established businesses. Even more mature businesses may experience tax losses in certain years due to temporary adverse trading conditions. Economic downturns, changes in market demand, increased competition, or unforeseen events like natural disasters can lead to periods of low revenue or even losses, which can be carried forward to offset future taxable profits. Using tax losses to offset future taxable income. The key benefit of a tax loss is that it can be carried forward and used to reduce the taxable income in future tax periods. This mechanism helps businesses that may have experienced a temporary loss, ensuring they do not face a higher overall tax burden just because of when the loss occurred. The ability to carry forward tax losses is designed to create a more balanced and equitable tax system, where businesses are taxed based on their long-term profitability, not on individual periods of loss. However, the carry-forward of tax losses is subject to specific conditions that must be met. The business must have taxable income in the future to offset the loss. The tax laws may impose a time limit on how long losses can be carried forward, typically a number of years. Offsetting tax losses between different businesses. In some jurisdictions, businesses may also be allowed to use tax losses incurred by one business to offset the taxable income of another business. This is particularly useful for groups of companies or businesses that operate under a parent-subsidiary structure. It can help businesses within the same group to optimize their overall tax position by sharing tax losses. However, this kind of offsetting is subject to stringent regulations, and not all businesses may qualify to apply losses in this manner. In some cases, businesses must demonstrate that they are under common control or ownership to benefit from the loss transfer mechanism. Limitations on tax loss relief. While tax losses offer significant relief, there are several restrictions and limitations on how and when they can be claimed. Losses incurred before the commencement of corporate tax. A business cannot claim tax losses that were incurred before the date of commencement of corporate tax in its jurisdiction. Essentially, any losses generated prior to the introduction of corporate tax are not eligible for relief under the current tax system. Losses incurred before becoming a taxable person. If a person or entity becomes a taxable person only after incurring losses, those losses will not be eligible for relief. For example, if a business was not subject to tax in the past but has since become taxable, any losses it incurred in prior periods are not deductible under the new tax regime. Exempt income losses. A business cannot claim tax losses that originate from assets or activities that generate income exempt from corporate tax. If a business has income from sources that are exempt from taxation, any related losses cannot be offset against taxable income. Small business relief election. If a business elects to benefit from small business relief, it cannot claim tax losses for the tax period in which this relief is applied. Small business relief typically offers a simplified tax regime or lower tax rates for qualifying businesses but also restricts certain benefits, such as the ability to claim tax losses.